Bill Ackman's Pershing Square just released its latest portfolio filings. And one thing jumps out immediately. Nike. It was once a billion-dollar stake, and it's nowhere to be found today. Zero shares. Now, many of you really enjoyed our deep dive into Ackman's $2 billion bet on Uber in the previous episode, where we broke down why it became his largest position. But today, we'll flip the script and take a closer look at a stock he appears to have completely walked away from, Nike. So Bill Ackman first initiated his Nike position in Q2 of 2024, picking up roughly 3 million shares back then. Then, in the subsequent quarter, Q3, he quadrupled down, adding another 13 million shares. Shortly after, the stock plunged from $93 to $74, following a disappointing earnings report. And finally, topped off the position with 2.5 million additional shares in Q4. So at its peak, the total exposure stood at over 1.4 billion US dollars. And during this time, Nike's share price actually oscillated between $70 and $97 per share, making it difficult for us to pinpoint exactly where Pershing's exact average cost is. But based on the timeline, it's likely most of the stake was actually built post the earnings dip in Q3, when the stock was trading at low to mid 70s range. Then came Q1 of 2025, which is the last quarter, and Pershing appeared to exit the position entirely, just as the stock was trading between 62 and 82. Now, that's a lot of numbers, but based on our estimates, Ackman likely broke even, or walked away with only a modest profit or loss. But what if we told you he actually didn't sell at all? So before we jumped into the exciting story behind Ackman's relationship with Nike, and if you love investment sharings like this one, I think you'll want to check out our free weekly investing newsletter, Investing Bites. So each issue actually delivers bite-sized lessons and real-world stories, straight from our team. So if this sounds like something that excites you, head down to the link in the description below and it will send the latest issue straight to your inbox. Now, let's break down what really happened. So Bill Ackman's investment in Nike wasn't just about buying a great legacy brand. It was really more about timing a turnaround play. So Nike, undoubtedly, which is still one of the most valuable and iconic consumer brand in the world today, had clearly lost the footing under its previous CEO reign. So the company leaned too heavily into the D2C sales pipeline, direct to consumer, and Nike Digital. It over-promoted key lifestyle franchises, deprioritized its traditional wholesale channels, and created a much more fragmented organizational structure, to say the least. And the result? Overpromotion, weakened wholesale relationship, bloated inventories, poor consumer demand, and slowing innovation. And all of which actually led to disappointing results and multi-quarter declines. So let's be clear, this is no longer a speculation or even an exaggeration. So the decline is showing up in Nike's reported numbers. Since May of 2024, the company has seen a noticeable decline in their top-line revenue growth rate. Operational missteps under the previous leadership have also taken a toll, with margins falling sharply across the board. You have gross margins dropping from 45% to 41%, operating margins from 15 to 7, and net profit margins from 12 to 7. I think you get the picture. Anyone buying into the Nike stock today is doing so with their eyes wide open. It's a turnaround bet, hinging on whether the new CEO, Elliott Hill, can deliver a better future. On a side note, I'm also hinging on you to help gently tap the like button so that we can continue serving you great content. Anyway, when Ackman first entered the position in early 2024, it was clear that a major reset was needed. And to Pershing Square's credit, they were betting not just on improving fundamentals, but also on management accountability. So that bet actually gained quite a bit of credibility when the long-time Nike veteran Elliott Hill was brought out of retirement in October of 24 to take over as the new CEO. So Hill previously led Nike's global commercial and marketing operations before stepping down in 2020. And Bill Ackman believes that he's the right person to refocus the company on performance, brand strength, and wholesale execution. In fact, investors were excited because Hill has spent his entire career at Nike, starting as an intern back in 1988, making him one of the most seasoned insider to ever lead the brand. And Elliott Hill's plan? Strip Nike back to its DNA, a high-performance sportswear, huge amount of product innovation, and strong wholesale partnerships. So it's cutting back the overextended lifestyle segment, refocusing the business around core athletic categories, and working to rebuild relationship with key retail partners. So the company is also reassessing its reliance on Nike Digital, returning to a much more balanced distribution strategy. Now, the truth is this: turnarounds are messy. This won't be a quick fix. Revenue doesn't snap back in a quarter. You have to clean out inventories, reset pricing expectations, and often even take hits to margins before things start to improve. And this is exactly the stage Nike is in right now. So Bill Ackman, however, believes that the foundation is there for a full operational and brand revival. So Nike still holds a dominant position in a highly consolidated footwear market, supported by long-term secular trends in the health and wellness space. So he has called this one of the great large cap consumer turnarounds in the making. And if margins return to historical levels, the upside could be extremely meaningful. So, the million-dollar question: why did Ackman quote-unquote sell his Nike position? Well, he didn't. The reality is, not only did Ackman not exit his Nike position, he might actually have increased his exposure by converting his entire stake into something called deep in the money call options. So as Pershing explained in their disclosure, and I quote, "This structure, which is the in the money call option, allows us to maintain exposure to the upside potential of owning the stock outright while unlocking capital for new investments." So in a successful turnaround, the options payoff should be more than double the returns from owning the common stock, unquote. So in short, it's a high conviction bet with a leveraged upside, and a clear signal that Ackman isn't backing away from Nike. So the natural question would then be, why? Why bother? Why convert stocks to options? So let's take a moment to break down what exactly is a dip in the money call option mean. In simple terms, a call option gives you the right, but not the obligation, to buy a stock at a fixed price called the strike price before a specific date. So when you buy a call option that's deep in the money, it means that the strike price is set well below the current market price of the stock. So that gives the option a lot of intrinsic value right from the start, which makes it behave very similarly to the stock itself. So let's give you an example. Let's say if Nike is currently trading at $75 a share, and your call option has a strike price of $50. So that delta, that difference, means that you're already $25 in the money. And that $25 act almost like a stock ownership. And if the share price goes up to $85, your option is now worth $35 in the money from the $50 strike. So some of you might ask, why do this instead of owning the stock outright? Well, it's mostly about capital efficiency. So buying the stock requires you to put down the full amount. But by buying a deep in the money call, it allows you to control the same upside potential with much lesser cash upfront because you're just owning the options itself. And here's the key part. This setup actually creates a kind of inbuilt leverage because you're committing less capital but still capturing most of the upside. And your return investment in this case is definitely magnified if the trade actually goes your way. So you don't need to borrow money or even use margin, as the leverage is already embedded in the structure of the options itself. But like any strategy, it comes with its own set of risks and challenges. First, for those of you familiar with options, options have expiration date. So if the turnaround actually doesn't materialize in time, or if the stock stays below the strike price when the option expires, you could lose your entire capital. Unlike holding shares, where you can sit through volatility and wait for a recovery regardless of the time frame, options actually come with a fixed timeline. So Bill Ackman has also disclosed that Pershing's Nike options are multi-year in duration, giving the thesis some room to play out. But that said, even long-dated options have a ticking clock. And when time runs out, it's over. There is no extension. Second, while options can magnify your upside, they tend to also magnify your downside. And that's the idea of leverage. The embedded leverage works both ways. And in the worst case scenario, the stock might only fall 20%, but your options could end up with zero worth if it expires below the strike price. And third, options don't come with shareholder privileges. There is no dividends, no voting rights, and you're not an owner. You're essentially renting exposure to the stock price's movements. So with this in mind, options is a tool best used with precision. not really a substitute for long-term equity investing. Of course, holding the options until expiry isn't the only way Ackman can profit from this option structure. There are much more advanced ways to managing the position, like rolling into new contracts, adjusting its exposure, or scaling in with additional options leaks, so on and so forth, depending on how the entire thesis plays out. There are active strategies used to manage risk and extend duration. But I think for normal retail investors with not much exposure or understanding, this kind of strategy can be useful in specific situations. But here's the thing, you need to be clear on the math, the timing, and the worst case scenario. Options can look deceptively simple, but the risks are very real if you don't fully understand how it works. And if you want a quick crash course on options, you can watch our Options Trading for Beginners guide with our mentors Bang and Adam, and we'll leave the link in the description below. So, where does this leave us with Nike? On one hand, the business still has a lot going for it, with a globally dominant brand, a leadership position in the footwear industry, and long-term tailwinds from health, wellness to sports. But on the other, it's facing real challenges, eroding margins, strained wholesale relationships, and a brand that's drifted a tad too far from its performance roots. And today, the roadmap to recovery seems pretty clear. Cut the overextension, rebuild trust and retail partners, and bring the product back to what made Nike iconic in the first place. But that's easier said than done. For this thesis to play out, it's not about waiting, it's a lot more about execution. And Elliott Hill may be the right person for the job, but investors need to recognize that this isn't a compounder in cruise control. It's a turnaround story, and those tend to come with messiness, volatility, and more than a few quarters of uncertainty. And if the turnaround works, we wouldn't be surprised to see the stock recover strongly from here. And that's a big if. And anyone stepping into this name should go in with both eyes open. Do leave in the comments down below on where you stand with Nike today. And this is CK from Piranha Profit signing off. Till next time, keep winning.